You can hear me? Can you hear me now? Okay. No, you know it's crazy. I didn't know that this thing was going to just invite everybody at once. So I was kind of confused. I was like, what the heck? Yeah, no, my here's not here. Gonna wait like we didn't give it 3 minutes. There's literally a lot of ground to cover in this class, and I'm gonna tell you guys. So many. How are you guys' day today? You guys made money? For those who are already trading. We had a pretty good day today. Kind of trade Tesla. The volume wasn't um, the best. Yeah, like an hour and a half to 2 hours. I like to talk. If you've been if you've been in my classes before, you know I like to talk a lot. Yeah. It automatically muted everybody, so that was a good thing. So it's not like when people join, it's like you just hear everybody just like you just hear everyone talking. Okay, so for everybody, welcome to the first day of class. Today I'm gonna kind of cover platforms, stocks in general, sectors, Dow theory, corporate actions, key events, sector rotations. And tomorrow we're gonna go over spotting trends, just the basics of technical analysis tomorrow, developing like strong foundations, developing a deeper understanding about potential upcoming as well as ongoing trends of the market, step-by-step methods of identifying trends, how to find trade entries, exits, stop losses, take profit levels, time frame selection to trade in whether it be day trading, swing trading, scalping. So I'm sorry, not tomorrow. In the day after tomorrow. Okay. You guys can see my screen, right? Can you guys like I don't like how like a lot of people just ask like questions before like like we get to that topic. You know what I mean? Like, so just bear with me. So getting started, welcome to Evolution. This is our live class. Okay, so this class is gonna turn into a self-paced course that you're going to be able to access using the password that Mahir sent to your email. If he didn't, he will today. Give me a second. What was I saying? So basically what's going to happen is you guys are going to be able to log in to the website, and this portion that we're doing in terms of coming here at 6 o'clock, right? That's just the live class, right? That's just the live class. The presentations are probably going to be the same in terms of inputting it into the website, or maybe it might be changed, just tweaked a little bit so that it's more easy to follow. Because when you're in the live class, you're hearing somebody talk. So, but when you have like the drop down modules, things like that, it should be more like a step by step thing. So you guys can get access to that, and you can access that for as long as you want. There's no time limit. It's just like taking any other course. You pay for it, you log in, and you have it there, right? So you can follow through with it. You can learn it by yourself at your own pace. But I mean, for those of you who are in the live class right now, I mean, it depends on how fast it takes you to kind of learn these things. But this is mostly for people who kind of are going to join like after May. So this course is just going to be like the course like for TCX, meaning it's going to be the only one that's going to be put on the website for now. I'm not going to be doing class next month, or I don't know. So as of right now, right, as of today, May 5th, our website, it's not fully finished yet, okay? But you're going to have access to it by the end of this month. I mean, hopefully you can have access to it next week. It's just that we want everything on there, right? I don't want to give everyone access to it next week, but the live class isn't even finished yet. Like Julian or Rod hasn't even presented their topics yet, right? So just gonna wait for that. So my hopes is that you learn from this class and course, and that you kind of utilize all the information that's going to be shared and taught. The end goal here is to give you basically, more trading literacy and teach everyone how to be consistently profitable using proven methods and different approaches. Okay, because everyone here should be here to learn. Okay, and when it comes to stocks, right, there's a lot of things you got to cover, right? You can't just go straight into charting if you can't understand the fundamentals of the stock market in the first place. Some of these things might not be new to some of you, so just it's gonna kind of be a refresher. So getting started. Unlike the previous classes, please refrain from asking questions in the Zoom chat, like every 5 minutes. We're gonna go with the course guideline, and we're not gonna be answering questions that pertain to topics that are meant to be covered at a later time in the course class. Risk disclosure. Disclaimer: future stocks and options trading involves substantial risk of loss and is not suitable for every investor. The valuation of future stocks and options may fluctuate, and as a result, clients may lose more than their original investment. The impact of seasonal and geopolitical events is already factored into market prices. I'm just reading the disclaimer, okay? The highly leveraged nature of futures trading means that small market movements will have a great impact on your trading account, and this can work against you, leading to large losses, or can work for you, leading to large gains. If the market moves against you, you may sustain a total loss greater than the amount you deposited into your account. You are responsible for all the risks and financial resources you use and for the chosen trading system. You should not engage in trading unless you fully understand the nature of the transactions you are entering into and extent of your exposure to loss. So, you don't just trade blindly and just follow someone and just go off of what they say, right? If you do not fully understand these risks, you must seek independent advice from your financial advisor. All trading strategies are used at your own risk. Any content on the evolution course should not be relied upon as advice or construed as providing recommendations of any kind. It is your responsibility to confirm and decide which trades to make. Trade only with risk capital, that is, trade with money that, if lost, will not adversely impact your lifestyle and your ability to meet your financial obligations. So don't ever risk money that is not expendable, right? Don't use, if you have $1,000 in your account, in your savings, and that's all you have to your name. Don't just throw that into the stock market. Past results are no indication of future performance. In no event should the content of this correspondence be construed as an express or implied promise or guarantee. I meant to put evolution class here. I was kind of in a rush. Evolution Course is not responsible for any losses incurred as a result of using any of our trading strategies. Loss limiting strategies such as stop loss orders may not be effective because market conditions or technological issues may make it impossible to execute such orders. Likewise, strategies using combinations of options and futures positions such as spreads, straddles, trades may just be as risky as simple and long positions. Information provided in this correspondence is intended solely for informational purposes and is obtained from sources believed to be reliable. Information is in no way guaranteed. No guarantee of any kind is implied or possible where projections of future conditions are attempted. None of the content published on Evolution Course constitutes a recommendation that any particular security, portfolio of securities, transaction, or investment strategy is suitable for any specific person. None of the information providers or their affiliates will advise you personally concerning the nature, potential value, or suitability of any particular security, portfolio of securities, transaction, investment strategy, or other matter. Oh my goodness, that was so long. Okay, you guys ready? You guys are still here, right? You guys didn't fall asleep yet? We haven't even started. Let me give this link to somebody real quick. Let me here wanted to join the thing, but he couldn't find the link, so give me 1 second. Okay. Best platforms. TD Ameritrade. Okay. I get this question asked a lot for some reason when the answer is kind of clear, right? TD Ameritrade has a combination of basically, reasonably cheap pricing on options. It's like 60 cents. Great beginner resources, and it's considered a top of the line trading platform that works well for both experts and the average trader. No matter where you are in your options trading journey, TD Ameritrade has something for everyone. How many of you guys use TD Ameritrade already? Yeah, you guys all use it, right? So it's very, very, very. It's at first it's not like easy to use at first, but once you get the hang of it, it's gonna be like game changing, right? I love TD Ameritrade because sometimes I don't want to go on my computer to look at charts, so I'll just use my phone while I trade. So I don't have to just sit in front of my computer because on Robinhood you can't just chart on Robinhood, right? You got the little lines, so it's not candles. You can't see anything like that. So Robinhood, free commissions, cool, free commissions, but it does not offer a lot when it comes to education and different tools. So Robinhood is essentially it's essentially a good platform when you want to trade, like when you want to do swing trades, for example, right? Because you don't have to you don't have to worry about filling, right? You don't have to worry about execution. You don't have to worry about your order not being filled because you're gonna hold it overnight or over several days. So I feel like Robinhood is good for swings. If you wanna grow a swing account, then Robinhood can be a good platform for you to use. I've had many cases where I've had trouble executing day trades and scalps on Robinhood, so I stay away from them when it comes to day trading. So it's all about personal preference at the end of the day. I mean, I know people who love Robinhood and they make a lot of money using Robinhood, and I also know people who hate using Robinhood. So with that being said, it's going to come down to personal preference, whether you like the simplicity of Robinhood or if you want to opt to a TD Ameritrade where it's slightly more confusing, but everything is laid out for you. You can find everything easily in terms of like all you got to do is just swipe your screen if you want to find the implied volatility, all these things. You can add on all these different features on Thinkorswim, right? one good thing I will mention about Robinhood is that if you ever decide to buy, spreads, right? If you want to buy strangles, iron condors, debit spreads, credit spreads, those kinds of things. If you go on, if you look up the stock, if you go on the first one, you can see that it lets you buy spreads like iron condor, strangles, debit spreads, credit spreads, and they have it for they have it already set up for you, and you don't have to manually input all the different legs that is required, for a certain spread. So that's why I kind of like it, because if I want to grow a small account, I'll go on Robinhood. If I want to grow a small swing account, I'm sorry, I'll go on Robinhood and I'll just buy a lot of debit spreads because they're so cheap. I'm gonna go over that whenever we get to spreads, but that's why I like Robinhood. TradeStation, I don't really use that. It was initially started as a software company. TradeStation is well known for being used as business portfolios. I know a few people who use TradeStation for their business portfolios. Not much to say. Not there's nothing else that I have to say about TradeStation because I don't use it. I don't want to give you guys the wrong information on that. Charles Schwab, I use this for my Roth IRA. They definitely have one of the best customer services out of all these platforms. They offer above average research and education offerings. So if you want to, and it has a nice desktop platform. If you've ever used this platform, um, I suggest if you want to go make a retirement account, like use Charles Schwab or E-Trade. Okay, Interactive Brokers. Anybody uses Interactive Brokers? I'm just putting out. I don't think anybody uses that here, huh? So it's best for traders who trade very frequently. Basically requires an above average portfolio to trade with them. They have a very professional grade platform. I've seen it before and it's crazy. And it's commonly used among professional traders. Like you if you go on StockTwits, maybe you see all these different people. Some of them are pretty good at what they do, and I use Interactive Brokers. So going to E-Trade, one of the oldest brokerages, has a very long history of supporting beginners and experts. Commissions are similar to TD Ameritrade. It's a very easy and intuitive platform. That's also a good platform if you want to open up like a retirement account, in my opinion. What are stocks? Right? There are two different types of stock. There's common stock and preferred stock. Common stock, it's an investment security, right, which represents ownership in a company. So I'm going to back up. So when you buy stock, right, you can't physically go. It's not a brick and mortar thing where you just go in and physically buy a stock. It's it's all online, right? So if someone says they own stock, it usually means common stock. Apple, Facebook, etc. They're referring to common stock. So if your friend or relative owns a few shares of a company, they are therefore an owner of they are therefore an owner of the company. Just a piece, right? You own that. This means that you own a piece of whatever you buy. Okay. There is also preferred stock. Preferred stock typically is basically a debt instrument of a company. So when you purchase preferred stock, just think of it as you loaning that company money, right? When loaning money to a friend, you expect to be paid back with interest. Okay, it's just two different types of stocks. Okay, let's go to stock sectors. The general economy and stock market are organized into two tiers. The highest tier, a sector, is a broad grouping of companies that have similar economic characteristics. There are currently 11 major sectors that most investors use when they break down the corporations and other issuers of securities such as stocks and bonds. Okay, so sectors in turn are broken down into subcategories known as industries. Okay, so this allows a closer grouping of similar businesses. For example, both Dollar Tree, the discount retail chain, and Tiffany and Company, the luxury jeweler, are included in the consumer discretionary sector. However, they are sorted into different industries. Financials. The financial sector consists of banks, investment funds, insurance companies, and real estate firms, among others. In general, the majority of the revenue generated by the sector comes from mortgages and loans that gain value as interest rates rise. AIG, GS, Goldman Sachs, JP Morgan. Can anyone name any more financial stocks? Wells Fargo, Bank of America. Exactly. Utilities. The utility sector consists of electric, gas, and water companies, as well as integrated providers. In general, the sector generates consistent recurring income by charging consumers and businesses that provide higher than average dividend yields. Okay. NEE, ENB, DUK are utility stocks. Consumer discretionary. So consumer discretionary is literally what we trade every single day. I'm pretty sure everyone can agree with me on that. You know, the consumer discretionary sector consists of retailers, media companies, consumer service providers, apparel companies, and consumer durables. In general, these companies benefit from an improving economy when consumer spending accelerates. Okay. Amazon, Home Depot. These are both trades that we take every single day, right? They have a lot of liquidity, they have a lot of volume every day. So these stocks are stocks that move. That's why we trade them, right? A lot of people are always asking, like, hey, what is the best stock to trade, for example? What should I look at? Because when you are starting out, okay, even when I first started, I was like, oh my gosh, what, like there are so many stocks. Like what, like even when I started trading options, I was still confused. I was like, what should I trade? Like there's so many names. Has anybody ever had that problem where they're just like, oh my gosh, like I don't even know what to choose. Right. And then you're over here looking for different scanners. You're like, you're typing on Google, like best stock scanner. You're over here trying to scan for stocks, but you can literally narrow it down to where it's easy, right? So this, you just got to think about it like this. So we trade for options, right? We want stocks that move, okay, that has a lot of volume every single day. So, you know, all you got to do is just find the stocks with the most volume, right? And after you kind of trade, after a while, you kind of already have an idea of what to look at, right? Because now, for like tomorrow, for example, what I'm going to trade is, it's either going to be Tesla, Amazon, Google, Home Depot, EA, Activision, Target, you know, Walmart, Apple, Facebook, Netflix, Tesla. You know, these names, these are big names, right? So there are, if there are more than like 50 big names, okay, you just have to narrow it down to like 20, right? If you can, what you guys should do is you should kind of make a list of the stocks that you can trade, meaning like this: if you have $1,000 account, should you be trading Amazon, for example? If you know, Amazon contract prices are like $1,000 on average. So, you know, if you think of it on a risk management basis, Amazon is not a good stock to trade if you have $1,000 in your account, because more more likely than not, you won't even be able to buy a good option on Amazon, right? Especially if you want to apply risk management. So that's why I feel like, especially if you guys are in like trading groups, like it's important for you to already know what you have to look at. Because if you put yourself in an environment with people, for example, a trading group, and you don't know what stocks are good for you, you're going to end up getting reeled into the trap where you might think it's okay for you to get into a big name and spend maybe 80-90% of your account on one trade just because everybody around you is doing it, right? So I'm going to do this real quick. So where if you have $1,000 account, right, you want to trade stocks that have cheaper premiums, right? Stocks with cheaper premiums are usually stocks that don't move too much, right? They still move, but if it only moves like $1, $2 a day, then more than likely the premium on that, it's going to be very cheap, which is good for you, right? Because the point is, right, the point of me telling you to look for stocks that are that you can manage according to what you have in your account is because if you can trade these stocks, right, these cheaper names where you don't have to risk, as much, what you're going to do is if you develop the consistency, you're going to be able to grow your account. Once you grow your account, that's when you go ahead and say, okay, I'm going to go trade Amazon today. Okay, I'm going to go trade Tesla today. Okay, I'm going to go trade Google today. Okay, let me show you guys an example for real quick. I'm going to go on options profit calculator and show you the different prices of stocks. So let's say you have let's say you have a $1,000 account, right? You want to trade Amazon, right? You just this is also a website where you can kind of calculate how much you can make on your trades. Let's say you want to trade Amazon. You're going to select the option. Just look at this, okay? So this isn't so when you're looking at an option chain, right? You always want to kind of revert towards the middle, right? Everything in the middle is what's considered at the money, right? I'm gonna go over this next week or maybe at the end of this week, but just to show you the difference in prices, right? If you want to buy an at the money call on Amazon, it's gonna cost you $26, right? How much are you really paying in premium on $26? You're paying $2,600 for an at the money call, right? Obviously, you have 1,000, you can't afford that. Maybe you want to go down here and buy this one or this one. You're like, oh my gosh, this one is cheap. This one is cheap. I'm gonna buy this one. This is $4. So meaning I'm paying $400, right? But just look at the just look at the strike price, right? Again, I'm gonna go over this later on, but I'm just showing you, right? If you look at the strike price, 2,400. It's like $100 away from where Amazon is at right now. So Amazon would have to make a significant move for you to even make some decent profit off of this trade. Now let's compare this to EA. Compare Amazon to EA. And get this price, select the option. Look, at the money on EA is $3. So you're paying $300 for one contract of EA. Okay, let's do that. You buy one contract of EA. Yeah, EA does have earnings, so it's kind of So look, let's say you buy one contract on EA for $370, right? If EA is currently at 119.6, if EA goes to 121, you make $74. This means that you're up 20%. Let me give you guys a quiz real quick, okay? So if you were to buy one contract of EA, right, and you're up here, oh, did I get bars? No. And let's say EA goes up to 122.5. Okay, so that stock went up about $2 from when you entered. Okay, and let's say you are up $162, 43% in profits. Would you take this profit or would you let it run some more? You would take it, right? 43% profit, that's really good. Okay, especially because these names, right, these stocks have an average movement every day, right? I'm going to go over that once we go over technical analysis, but to sum it up, all these stocks have an average movement per day, right? If you look at it from a whole year's perspective, okay, you can kind of find an average of every single day. If EA has only moved $3 per day on average for the whole year, then it has a $3 average range, right? Now, if Amazon moves around $30 to $40 every single day consistently for a whole year, then that has an average range of 40. So like I mentioned right now, as an example, okay, if you buy EA at 119.5, so close to 120, and you're up to 122.5. So now you're getting close to that $3 range, right? Would you take profits or would you let it run? Right, you would take profits because it's already getting close to the top of that range, right? if you were to keep holding this, it's just gonna create that anxiety because especially if you already know, like, oh my gosh, EA moves $3 per day on average, and my position, right? I just took advantage of that whole $3 move, right? Anything after that is considered greed, right? It's not you letting it run because you already know what the average is. If the average is $3, then yeah, you should take profits, right? Because what you're doing is now you're pushing it, right? Because what can happen is you can hold it and it'll drop because people want to take profits, right? Hopefully that made sense for some of you. Now, going back, consumer staples. Consumer staples sector consists of food and beverage companies. Now, while I say this, I want you guys to kind of throw out different names out there in terms of consumer staples. So these are companies that create products consumers are unwilling to cut from their budgets. So what does that mean? Essential, right? These are essential businesses, right? No, like if you want toilet paper, you have to go to, Costco, Ralph's, Target, Walmart, right? So in general, these companies are defensive plays. So these companies are able to withstand an economic downturn. Have you guys seen Costco right now? Right? You guys seen some of these different names. They're not taking as big of a hit as some of these other names, for example. Right? So these are names that are good for you to essentially buy into when you have when the economy faces, a hard time, right? Essentially they are recession proof. Energy, okay? Energy sector. The energy sector consists of oil and gas exploration and production companies, as well as integrated power firms, refineries, and other operations. In general, these companies generate revenue that's tied to the price of crude oil, natural gas, and other commodities. So you have WMB, DVN, HES. Healthcare. The healthcare sector consists of biotech companies. Can you guys name some biotech companies? Hospital management firms, medical device manufacturers, and many others. In general, the sector is considered to be both a growth opportunity and defensive play, since people will always require medical aid. So if you're so like this, you can take this approach, right? I was looking at UNH the other day. We had that bull flag. So in my mind, I was already thinking like UNH is a defensive play, right? It's a healthcare. It's within the healthcare sector. So if I'm gonna swing, for example, if I'm gonna swing calls on defensive stocks, I am not going to have as much anxiety when I'm holding these names because I know that they're stable, right? They're not gonna just freaking, dump like $100, in one day, like Amazon or Tesla, right? So I don't have to worry about large fluctuations when I'm holding these names. Okay. Industrials. The industrial sector consists of aerospace, defense, machinery, construction, fabrication, and manufacturing companies. In general, the industry's growth is driven by demand for building, construction, and manufactured products like agricultural equipment, LMT, HON, Caterpillar. You guys know any more industrial stocks? X, right? US Steel, right? Yes. SPCE. Okay, good. I'm glad you guys know these names. So, stock sectors, healthcare, industrials, consumer discretionary, consumer staples. Okay, these are just pictures. Telecom. The telecom sector consists of wireless providers, cable companies, internet service providers, and satellite companies, among others. In general, these companies generate recurring revenue from consumers, but some subsets of the industry are facing rapid change. Now, I want to talk about this sector real quick. When it comes to the telecom sector, okay, what do you guys think the growth is going to be within the next 5 years? Right? 5G. I was just thinking about that too, right? 5G could maybe get this up and running, right? Because these companies, you're using Verizon, Sprint, T-Mobile, AT&T, whatever the case may be, you still have to pay them, right, for you to use your phone. So it's not like they can just lose money off of people not buying their things, right? Materials. The material sector consists of mining, refining, chemical, forestry, and related companies that are focused on discovering and developing raw materials. Since these companies are at the beginning of the supply chain, they are very vulnerable to changes in the business cycle. Real estate. The real estate sector consists of companies invested in residential, industrial, and retail real estate. The main source of revenue for these companies come from rent income and real estate capital appreciation. As a result, this sector is sensitive to interest rate changes. What do you guys think would happen if interest rates went up? What do you guys think will happen to the real estate sector? Less borrowing, right? Vice versa, okay? Now, futures, right? What is the futures market? So a futures market is essentially an auction where people buy and sell commodities and futures contracts for delivery on a specified future date. Examples of future markets are the New York Mercantile Exchange, the Kansas City Board of Trade, the Chicago Mercantile Exchange, the Chicago Board Options Exchange, and the Minneapolis Grain Exchange. Futures markets are more than simple agricultural contracts. It involves buying, selling, and hedging of financial products and future values of interest rates. Okay. Now the ES, right? The mini S&P 500 futures. Okay. It provides one of the most efficient, liquid, and cost-effective ways to gain market exposure to the S&P 500 index. Right, a broad-based capitalization-weighted index, the S&P 500 tracks 500 of the largest companies of the U.S. economy and is a key indicator of the stock market's health. Right? How many of you guys, look at futures every morning, or just, how many of you are looking at futures in the past hour? Right? So everyone should know that you need to look at futures, right, before the market opens, after hours, whatever, just to kind of see where the market is at, right? So we look at ES to figure out where the overall market is at or headed, okay? Now, let's talk about the Dow theory, okay? Now, the Dow theory has been called the grandfather of stock picking theories. With over 100 years behind it, it's the oldest major idea for selecting winning stocks. This also makes it the most enduring and long-lasting idea in the modern financial markets, right? So you have the accumulation phase, the public participation phase, distribution phase, okay? These are the different phases of the Dow theory. There are basically 6 ideas to the Dow theory, okay? The first idea, it's a very critical idea. It states that all relevant current, past, and also future information on the markets is already known by them and demonstrated in the indexes and individual stock prices. This covers all influencing factors from interest rates, inflation, investors' emotions, and even imminent to be released earnings announcements. So everything is essentially what? Priced in, right? It tells you that only information which cannot be known is not covered by the prices, yet even event risks are factored into the prices. Okay, so all these events are already factored in. Okay, changing events, information, and risks they cause adjustments in the market prices. The market is made up of three trends, right? Markets usually move in an overall direction, but seldom in a one-way line. Okay, I feel like a lot of people think the stock just goes up like the whole month, right? A lot of people have this wrong idea when you start trading, right? Just because we had a good month doesn't mean that it's going to be the same, right? How many of you have had a good month and then the next month it was like a little bit shitty, for example, right? And then, for example, right, when you have a shitty month, right, how many of you, right, first you're like, you think that it's just you. You think it's you, right? You think it's like, oh man, like why is my trading, why am I not, you know, consistent right now? Why am I not, you know, seeing the same results as I was seeing last month? Why is this? Why is that? So when it comes to understanding how the market works, right? You have to understand that if you, for example, if you want to grow an account, okay, you want to grow an account, let's say from like 1,000 to 10,000, right? Do you think you have a better chance growing that 1 to 10 in a month during a bullish month or during a sideways month, right? It only makes sense during a bullish month, right? The thing is, people have this wrong idea. Like, you guys, like, people come into the market and immediately think, okay, because I know someone who turned 1,000 into 10,000 last week. So what I'm gonna do is I'm gonna put money into the market right now, and I'm gonna do exactly what he did, right? But what he failed to realize is his friend who turned 1,000 into 10,000 in a week, right? He probably made like 3 trades and it ended up catching a really, really, really big move, right? If Amazon moves $300 in 1 week, okay, and you catch that whole thing, if you luckily catch that whole thing, then yeah, of course you're gonna grow your account, right? But when you run into a sideways market, you're not going to make the same amount of returns as you were during a bullish market, right? Because you're not able to capture the same amount of moves. And not even that, you're going to run into trades where it's just going to fake you out, right? And you can't do anything about that. It doesn't matter how good your system is. It doesn't matter how good your trading is. If you've been trading for a whole year, you've been consistently profitable because you've been in a bull market, and then you run into 3 months of consolidation, right? You don't automatically rule out, you know, the fact that you think it's you. Like, it's not, sometimes it's just the market, right? Sometimes your system is good, but just the market doesn't presents you enough opportunities, or it just fakes you out, right? So what happens is, I'm going to talk a little about psychology when it comes to sideways here. When you run into a sideways market, what usually happens is, right, you know, let's say you've had a good month, right? Oh yeah, I've had a really good month. I made $30,000 last month. I'm going to try to do it again this month. But you really don't know what's going to happen. You just assume that you're going to make the same amount because you did it. You're like, okay, I made 30,000 last month. I know I could do it again. I did it, so why can't I do it again, right? So when you have that mentality, it's like you come into the market now expecting to make the same amount, right? You come into the market with that mentality. You're like, I'm gonna make 30,000 this month. So what you do is, instead of waiting for opportunities to show up, you go ahead and look for them. Now, you're not supposed to look for trades, right? You're supposed to let it come to you, right? So what I usually do is, okay, I usually just browse the names that I already know. This is during market hours, by the way. I just browse the names I already know, go through like NVIDIA, AMD, Facebook, right? Like for example, if I go to NVIDIA first, right? If I don't find anything, I'm not gonna spend 15 minutes trying to look for a trade on NVIDIA. If I can't find anything within the first 30 seconds, right? Even if I switch from a 5-minute time frame to an hourly time frame to a 4-hour time frame to a weekly time, if I can't find any setups that presents itself to me on that stock, then I'm just gonna exit out and I'm gonna go on Apple. If I can't find anything on Apple, I'll go on Home Depot. Okay, so that's why like I don't trade. I don't like, you don't see me trading like 10 different names, like, you know what I mean, like all at once. Okay, because I have to really look, especially because I run a trading group, so I really have to look for names that can potentially move, because I know that a lot more people, a lot of people are going to end up getting into it after me, right? So you have to wait for these opportunities to come. Now, if you can't find an opportunity, right, then just walk away. Right? There's nothing wrong with you walking away. It's better to keep your money than to lose it, right? But the thing is, that's not how a lot of people's brains are wired. They come into the market feeling like they're obligated to trade and they have to make money that day. Oh, I'm so excited to make money tomorrow. How do you know you're gonna make money tomorrow? Like, you never hear me say, oh my gosh, I'm excited to trade tomorrow and make freaking $10,000, right? I don't know that. I don't know what's gonna happen. For all I know, I can lose $10,000, right? Nothing is guaranteed in the stock market. You just have to be able to execute, right? And that's what we're gonna teach you here too, is how you can execute your trades, right? Gain that confidence. So primary trends, okay? Primary trends are the biggest and typically endure over a year, okay? How many of you guys believe that we had, let me see, let's go look at an example, a real life example. Yeah, it's taking a while, I don't know why. Let me reboot it. Oh, I guess I can't go on it. Sorry about that. Yeah, it's not letting me. Anyways, you guys get the point though, right? Primary trends undergo 3 phases. The first accumulation phase begins the upward price movements. At this time, the knowledgeable and smart money investors move into the markets. Okay, this is the accumulation phase. Okay, the higher low right here. You got. Can you guys see the example here? The higher low right here suggests that the trend is shifting, okay, and is used to trigger accumulation. Okay, so had this big dip, okay, created a low here, and then we kind of went up, had a dead cat, went all the way back down, found support, went up, found support again. But this time, this support is higher than the previous one. So in this example, it's showing you that the third support, which is higher than the second one, is what kind of shifts the trend, okay? And it triggers the accumulation, right? Mass participation phase is the point where the negative sentiment that surrounded the markets in the accumulation phase has been overcome with improving business conditions. Did you guys get that part? Mass participation phase. Okay? Where are we right now, do you think? Do you think we're already at that mass participation phase yet? No, I don't think so either, right? Because it says the mass participation phase is the point where the negative sentiment that surrounded the markets in the accumulation phase has been overcome with improving business conditions, right? The stay-at-home order is still in place, so there is no improving business conditions, right? All these people who are opening up their businesses that are non-essential, they're getting arrested left and right? So, I mean, I don't agree to that, but I guess it's the law, right? I guess you can't open up a business during this time. The longer the better news comes out, the more investors pile back into markets, causing prices to go higher. This is the phase which lasts the longest and provides the biggest movements in price. Okay? Dow theory. Again, accumulation, and then what is this? Participation, right? We were just talking about this. This is the participation phase after it accumulates. Okay? This is where all the people who want to invest their money, right? For example, people who throw money into their Roth IRAs or people who start, buying up shares, things like that. So this is when it happens after the accumulation phase. Okay. The final period is appropriately known as the excess phase. Okay. Now, before I even go to that slide, can you guys tell me what an excess phase is? Just by the name. Boom, a bubble. Too much, right? It's the point where it's like, dude, like this, like last year. You guys remember? Was it last year? Yeah, last year when everyone thought that the stock market was gonna crash because we were so far away from the moving average, right? You guys remember when SPY was so far up away from the moving average, and everyone thought that we were gonna go down, but what it did was it kept going up, right? So the excess phase, by this time, markets have notched significant gains as more and more people have entered the markets and the price move begins to get tired. Most of all, the investors are in, but the smart money investors are already beginning to sell out to those just coming into the markets, right? Alan Greenspan, so he basically called this the extreme enthusiasm euphoria phase of the stock market. Okay. Major changes, market indexes have to confirm one another. Now, this is an important one too. Major changes from bull markets to bear markets or the other way around only signal when two main original indexes, right? These are the two original indexes, the Dow Industrial and Dow Transports. This is so changes from bull markets to bear markets, they only get signaled when these two agree with each other, right? Now, let me tell you this. Can you guys give me an example of a Dow Industrial stock? I'm going to give you guys a good example right now. No, not Boeing. Cat, Triple M, Apple, Cisco, Disney, Intel, right? IBM, Nike, Walmart, Verizon. Okay. Now, what about Dow Transport stocks? FedEx is a transport stock. What else? Uber, yes. I said FedEx. Southwest Airlines, Delta Airlines, American Airlines, CSX, United Airlines, JetBlue, right? So when these two when these two indexes start to agree with each other, right? That's when the major changes happen. Okay? If while one is in a downward trend and the other is beginning a primary uptrend, you should be careful and in believing new overall trends have started, right? Not a lot of people, look at these indexes and kind of like what I do is like what I like to do is um I don't especially when I day trade, I don't necessarily use this, but if I want to get into an Apple trade, okay? Let's say I'm looking at Apple and I'm looking at Facebook and I want to trade those two. I want to buy calls. Right. Now, let's say Amazon, Netflix, and Shopify are doing very, very good. Okay? If they're doing very, very good, what do you think will happen to Apple and Facebook? Just because these other names that fall into the same, right? Just because they're doing good, what do you think will happen to Apple and Facebook as well? They're also gonna go up, right? Especially when you look at SPY. So whenever I'm trying to trade something, I don't just come into the market saying, "Oh my gosh, Nvidia, I'm gonna trade it now." I never do that. I never ever do that, right? I don't care if it's gonna take me 5 minutes to figure out whether everything else is correlating with it. I'll take that time, right? Because I don't want to end up getting into a position where it's like I entered just based on that single stock, right? I don't just go into Facebook just because I want to trade Facebook and not look at SPY, Nvidia, AMD, or Amazon. I have to look at these other names. I have to make sure that they're going up too, right? Because what if how many of you have gone into like an Apple trade and then Facebook, Amazon, freaking Boeing or Netflix are all dumping and you get into an Apple call? What usually happens? Usually dumps, right? It usually follows the overall market, right? So, make sure when you guys are getting to these trades that you kind of correlate yourself when you are trying to, for example, day trade it or swing it. So this is the thing with swinging. I want to mention this too. Especially when you're swinging stocks, okay? If I'm gonna look to swing Apple, right? I kind of have to make sure that, for example, Facebook and Netflix also have a bullish confirmation in terms of a potential breakout. Okay, like for example, if you see a bear flag on Amazon and on Netflix, but then you see a bull flag on Apple, would you still swing Apple? No, right? Because what can potentially happen after hours just from the fact that Amazon and Netflix are bear flagging? It's gonna dump after hours, but we're not even gonna see it dump after hours. What will usually happen in the morning when you wake up and the market opens? You see a gap down, right? And now you're looking at your Apple trade. You're like, what? There was a bull flag. I thought it was gonna break out, right? But what you failed to do was you failed to look at these other names that also are market moving names, right? You fail to look at these other names and kind of make sure that they agree with your Apple trade, right? If I see Amazon forming like a triangle, right, a bullish triangle, or if I see it forming a bull flag and I want to trade Apple because it's forming a bull flag, then yes, I will definitely get into that trade, right? Because when you see these patterns, so like I said, I'm going to talk more about this when we get to the technical analysis aspect of this course. But when you see these patterns, there, it tells you a story. It literally tells, like, if you're looking at candlesticks plus patterns, it'll tell you, you can already gauge what's happening just by looking at it, right? You see a long wick on the bottom, that's buying pressure, right? You can kind of see, okay, so buyer stepped in here, more than likely, right? You got to kind of add common sense to it too, right? If someone, if for example, right, if six people end up buying calls at 200, okay, and at 202 there are two sellers that are trying to short the market, do you think the price is going to break out, or is it going to reverse back down? It's going to break out because you have more buyers there, right? So what I'm saying is, when you're looking at these candles, especially if you see the volume or patterns, you can kind of gauge, I'm not talking about the amount of buyers in terms of numbers, but you can already see whether there are more buyers or whether there are more sellers. Okay. And if you don't already know how to spot that, don't worry about it. I'm going to teach you that. I'm going to teach you everything. Right. So you guys are good to go. Right. Now, the Dow Jones Industrial Average is the second oldest U.S. market index after the Dow Jones Transportation Average, which contains 20 transport stocks such as railroad and trucking companies. The Dow Industrial Average was designed to serve as a proxy for the broader U.S. economy. Okay? Dow Industrial Average ETF, DIA, Dow Transportation Average ETF, it's IYT. Make sure you guys have this down and know it, right? An exchange traded fund, an ETF, is a type of security that involves a collection of securities, such as stocks, that often tracks an underlying index. Although they can invest in any number of industry sectors or use various strategies, ETFs are in many ways similar to mutual funds. However, they are listed on exchanges, and ETF shares trade throughout the day just like ordinary stocks. Some well-known examples of ETFs are SPY, and what else? Can you guys tell me any other ETF names that you guys already know about right now? Oh, wow. USO, Triple Qs, IWM. Good names. Good names. Okay. Now, volume is required to confirm trend. See, it even says it on the Dow theory, right? This will definitely apply to day trading too, right? How many times have you seen the volume bar just shoot up during a breakout, meaning the volume supports that breakout? You guys have seen it a lot, right? You guys have seen these names break out and the volume picks up and you're like, oh my gosh, I'm going to get in the trade now. The volume just picked up, right? The volume is the amount, for those who don't know what volume is, the volume is the amount of shares that have traded or are being traded. This is the secondary measure that confirms a new trend is beginning, as demonstrated by the movements in price. This simply means that if the price movement is going in the trend's direction, the volume is going to be greater. Conversely, if price is moving against the trend, volume should drop, right? If the volume increases, what does it mean when the volume increases? More buyers, right? An increase in volume means that there are more people who are stepping in to buy that stock, thus raising the price of the stock, right? And yeah, it applies to sellers too. Trend is ongoing until a clear reversal emerges. A trend will continue until and unless an overwhelming amount of evidence indicates that this has reversed. Okay? You should only buy into the idea that the trend has changed if the evidence is clear enough to make a safe assumption. What is considered a safe assumption on a reversal? Do you guys think? And it doesn't even have to be anything that has anything to do with charts. What are some news that can be used as evidence to indicate that the trend is going to reverse? You know, bad earnings, right? All these things, right? Coronavirus, unemployment numbers. Do you guys see the unemployment numbers today? You know, they were saying that it's going to get worse than it was in the 1940s. And then you just, how many of you saw that SPY drop today? How many of you saw all these names drop in like 3 minutes today? You know, I mean, good thing I was already done trading that day, but like, you know, these things like the good thing about trading right now, right? The amount of experience that people are getting during this time right now is insane. Okay, it's insane. It was not like this last year. Let me fucking tell you that. Yeah, last year was smooth. Okay, last year was so smooth. Like I didn't even have to try as hard to kind of be like be consistent, right? Because there weren't as much reversals. There were not as much, you know, this and that, right? So embrace the fact, even if you're losing money right now, okay, any money that you lose while you trade is just going towards, you know, this learning experience. Okay, money comes and goes. You can always make money, okay, but the learning experience that you get right now, it's better than if you were to just stop trading and come back next year, right? You're getting, a lot of people are getting a lot of experience right now, just, you know, trading this kind of market. Okay. So trend is ongoing until a clear reversal emerges, right? You should only buy into the idea that the trend has changed if the evidence is clear enough to make a safe assumption. Otherwise, you end up trading contrary to the trend, which is generally a terrible idea. The trend is your friend. Okay. What is a corporate action? A corporate action is a move enacted by a publicly traded company that encourages or furthers processes that have a direct impact on whatever assets the company issues. In other words, any actions conducted by a company that materially alter or otherwise change the company can be considered corporate actions. Can some of you guys give examples of corporate actions? Is a CEO getting fired a corporate action? Are acquisitions corporate actions? If Google, if Google acquires Zoom, is that a corporate action? So there are different types of corporate actions. Okay, you guys have to kind of pay attention to this because especially when it comes to corporate actions, like this is, can you can if whoever has been trading for quite a while, can you say that when you see news of a corporate action, if it's good, the stock usually goes up? Yeah, right. So this is like very important, right? Corporate actions are very important. Economic calendar. How many of you pay attention to economic calendars? So for those that do not pay attention to economic calendars, this is where you want to go. Okay, you can either just go straight to Market Watch, or you can search up economic. I always look at the economic calendar before I trade every morning. or I use, you know what I used to do? I used to print it out every week. I used to print out the whole week and put it on my wall and look at it every morning before I, like, after I wake up. Oh, look, um, what is it called? He's speaking today. He's speaking today. He's speaking. So I have to make sure like I know who's speaking, or what's happening, so I don't just kind of have a biased opinion on where the market's going. So you go on marketwatch.com, right? Go to economy, go to the economic calendar. So this will show you all the events, right? All the reports and the Fed. This week's major US economic reports and Fed speakers. Who is the most important speaker on an economic calendar for you to watch out for? Is it Trump or is it Powell? Some of you say Trump, some of you say Powell. Who is more important in terms of economic calendar? Powell, right? Powell is definitely, you know, every time he talks, like I like sometimes like if he says one thing that's bad, I just shake my head. I'm like, dang, the market's probably gonna tank now. You know what I mean? So look, employment reports, um, non-manufacturing indexes, market services, unit labor cost, initial jobless claims, unemployment. So look, which one of these, just by looking at this, okay, this week, okay, don't look at Monday, May 11th. Which one of these you think is going to be a very, very important? Unemployment rate, right? This is going to be pretty important, and jobless claims too. So we don't have to worry about that tomorrow, but we're going to have to worry about that on Thursday, right? So make sure when you guys are before you guys even trade, you kind of look over this for the week, right? You look at what's happening the next day, who's speaking, right? Because once you find out, like if I'm looking at this unemployment rate, right? Just by looking at this, I'm already like, you know what? I don't think I should be swinging calls right now, especially okay, if it's Thursday and you know that unemployment rate is going to be there at 8:30 a.m., are you going to be swinging calls? Because we're already anticipating this number to be what? To be low, right? To be bad. Okay. It doesn't matter whether the stock goes up the next day or not, but just the fact that you already see this, that this is going to happen, that there's going to be news on this, you should already think to yourself, like, maybe I should kind of step back and just watch and see what happens after this, right? There is no point, because you don't have to trade. Like I said, you don't have to trade every day. So you don't have to kind of force yourself to get into something just to try to make money, right? Just look at these events too, right? Kind of figure out whether, okay, should I get into a trade? So should I buy calls on Home Depot expiring next week, right? And then look, and then you look, and then let's say 4 days from now, there's unemployment rate that's going to be posted, and your expiration on your contract expires the day after the unemployment rate shows up. Okay, so when you think about these things, you should kind of figure out, okay, maybe I shouldn't buy calls, maybe I shouldn't buy puts, maybe I should just stay cash, right? I do that sometimes. Sometimes it's best for me to just stay put and see what happens after the report, see how people react to this report, right? Because once I see the reaction after the report, then I can gauge where the stock might go. Does that make sense? Because if you trade, if you swing, if you swing something, right? If you swing trade a stock, and you want to swing trade through the unemployment rate numbers, right? You're blind trading, right? Because you're trading and you are not even paying. You're not even taking into consideration the numbers that can pop up tomorrow, right? The unemployment rate. So make sure, right? I'm just gonna say that again. Just make sure that you guys um, watch these economic calendars because they definitely help me a lot, especially when I'm trying to swing something that's like 2 weeks out and I'm about to go like really heavy. If I'm gonna buy like four different contracts on like Apple or Facebook expiring in a week, and if I see this, I'll definitely exit it. Like I will not hold it at all. I want to see what happens after the numbers, and then maybe I'll re-enter those calls, or maybe what will happen is I will end up not even going calls now because the numbers are so bad and the market's reacting to it so harshly to where everything is just dumping. Then maybe I'll go buy puts to swing now. Now let's go back to the slide. What number are we on? Sector rotations. Okay. There is a general market wisdom that certain sectors perform well and other sectors perform poorly during different points in the economic cycle. What sector do you guys think is performing well right now, and what sector do you think is performing poorly? Right? Health stocks are doing pretty well. Real estate's doing bad. The travel is performing bad. So if you had known this a month ago, 2 months ago, would you short Boeing, for example, or just or American Airlines? Just kind of knowing that it's literally like this literally requires no analysis, right? All it requires is common sense, right? If you just think about it, if we go back a month ago from now, you're just thinking about it like, okay, coronavirus, nobody can travel, so well, I mean, like how are they gonna make money, right? You guys have seen how much they've fallen from the last month, right? Just the airlines itself, right? Even though all these other names are kind of rising up, airlines were taking a dump today, last week, 2 weeks ago. You know what I mean? Fidelity, right? Fidelity notes that sectors like consumer staples and utilities, commonly held as defensive sectors, they can be used by investors to outperform during an economic recession. Now, think of it like this. Like, would you do this? Would you, if, let me give an example. For example, right now, is it safe to, let's say, um, buy Walmart calls and Target calls and Home Depot calls? Okay, now let me ask this question. Is it safe to buy Walmart calls, Target calls, and short airline stocks? Okay, everyone's saying yes, but are you guys doing that? Right? It's it's the right answer though, right? It's safe to do that, right? But why aren't people doing it? So, in my opinion, right now, right? I think it's safe for people to kind of like, let's say, right now, I would, if I'm gonna short, for example, if I'm gonna short Apple or Facebook or Boeing, I can short them, but buy Walmart, Target, Costco calls, or maybe not even calls. Maybe I can buy the shares outright. safe to say, right? Because knowing about sector rotations, right, I can already kind of gauge that, okay, it's going to take a lot of these companies a while for them to kind of, get their business back up and running to where they used to be 4 months ago, right? Whereas if you look at Walmart, if you look at Target, if you look at Home Depot, everyone is going over there every single day. This virus probably, they're probably making money. They're probably making more money during coronavirus than Black Friday or than like Christmas or Thanksgiving. You guys agree with me on that, or you guys think that they're still not going to make as much money as they do on holidays? Right. The third day of coronavirus, in the United States, you guys remember when everyone was fighting over toilet paper? You know what I mean? People were probably scared. They probably thought they were gonna get shot going to the freaking grocery store trying to buy toilet paper. It's just a lot of mass panic, right? If you can kind of understand the psychological aspect of how like the brain works, I feel like it can really help people when it comes to trading, because like if you can kind of gauge the uncertainty just based on how well you know um how people think, right? That's why I feel like psychologists are the best traders. Types of rotations: value based. There are value based rotations. There are relative momentum based rotations. There are trend following based rotations. Now I'm not going to go in depth with that today, but just know that there are these three types of rotations. Okay. What kind of trader are you? What kind of, just based on this slide you're looking at, what kind of trader are you? Scalper, day trader, and swing. Okay. So day traders, right? For those who are brand new to stocks, if you're day trading, you're buying and selling, okay, same day. Swing trading, you're buying and holding overnight to maybe a few months. Maybe that's a little too much. I haven't even swung anything for like 6 months like straight. Sometimes I just get like too iffy. Like I'm just like, I've been holding this for 3 months. I can just use this money to go buy an Amazon trade right now. Sometimes that'll happen. You know, Scalper, buying and selling within seconds to minutes. Okay. Position trader, buying and holding for months to years. So if you buy an option that expires in a year or two, right? If you buy an option that expires in a year or two, what kind of trader are you? Position trading, right? What is a good position trade right now that you guys can think of? Airlines. Yep. Definitely airlines. What about SPCE? Do you guys think SPCE, Virgin Galactic, is a good position trade? I think so too, but it just depends on where they want to go with it. We already know what SPC is, Virgin Galactic. You go up into space for like 10 minutes and you pay $250,000 just to go into space, right? Then you come back down. But I mean, people still would pay for that. um, Semiconductors. What do you guys think about semiconductors like Nvidia or AMD, especially AMD? Okay. These are good names, right? Because technology is always going to improve, right? whatever product that is going to help you make your lives easier will appreciate over time in terms of its value, in terms of the company's value. Does that make sense? Cash and margin accounts. Who has a cash account? Who has a margin account? So if you're on Robinhood, you cannot have a cash account, right? Cannot. You're stuck with margin. It used to be you can have a cash account on Robinhood, not anymore. I don't know why, but it's not there anymore. Yeah, you can't trade options on there. So in a cash account, all transactions must be made with available cash. I'm gonna show some risk management after this to end the class, but after I explain all this. When buying securities in a cash account, the investor slash trader must deposit cash to settle the trade or sell an existing position on the same trading day. So cash proceeds are available to settle the buy order. Okay, so if you have $1,000, right, and you use that all on one trade, for example, in a cash account, you cannot access that money until tomorrow. Even if you let's say you made $500. So now that 1,000 turns into 1,500. You won't be able to access the 500 or the 1,000 you just used until tomorrow. Cash trading is simply buying and selling securities using cash on hand rather than borrowed capital or margin. Most brokers offer cash trading accounts as a default account option. Since there's no margin provided, these accounts are much simpler to open and maintain than margin accounts. Okay, margin accounts lets you borrow money to invest in a particular security. It's similar to getting a mortgage to buy a home, only you're getting a margin loan from your brokerage to buy and trade stocks. Okay, now let's go over some risk management. Okay, I don't want to type this in because I didn't. So let's say I'm gonna what is a base average account size, do you think, on average? 2,000, 5,000? You guys want me to use 5,000? Let's do 5,000 as an example, okay? A $5,000 account, right? Should this be a cash or margin? Cash, okay? Should be a cash account. I don't know why people would have freaking a margin account if you have less than $25,000, right? If you have less than $25,000 and you have a margin account, there's a PDT rule, okay? So where you can only day trade, right? What is day trade again? Buy and sell the same day. You can only do that 3 times in a week. So essentially, you can only day trade 3 times. Everything else is swings. That's horrible, right? Because some people like to trade like 6 times in one day, right? But in and out, in and out, in and out, in and out. You can't do that with the PDT account. That's why it's best to have a cash account so you grow that cash account and then you can move on to margin once you're at like 30, 40, or 50, right? There's unlimited trades to cash accounts as long as you don't use up the whole thing, okay? Now I'm going to show you guys something. So this is you have a $5,000 account, okay? And how much is a good risk percentage to use just in general for day trades? Although it depends on the person, right? Because the reason why I say that, okay, if you take someone that's experienced in the market and you give them 5,000, and then you take someone who's brand new that is barely learning how to kind of manage risk, okay? Now, is it safe to say that just because the person I'm saying Is it safe to say that the person who has $5,000 and is experienced, is it safe to say that it's okay for him to risk more than 50% of his account because he knows what he's doing? Yes. I'm going to say yes to that. Okay? Because if you know what you're doing, right, and you use up 80% of your account, for example, 5,000 times 80%, right, which is 4,000. If you use 4,000 on a trade, okay, and you know your stop, right? Let's say your stop is like 10% or even 5 to 10%. That's your stop, okay? And let's say you're trading a potential breakout. So now you have all these favorable conditions, right? Does that make sense? So let's say you use 4,000 in your account, and let's say you get faked out, right? You get stopped out. 4,000 times 5%. Max, minimum you lose is 200, and max you lose is 400, right? Now, although this is a big number, okay, when it comes to just this account, a $5,000 account, you lose 400 bucks, right? It's a big number, right? That's still a hit. But if you already know what you're doing, right, then you're going to keep it within this range, right? Now, what if you take someone who's brand new to the stock market, barely learning risk management, but he can't manage his like emotions when he's trading, and he uses $4,000 on one trade? And what do you think will happen once he gets faked out? Starts with a P. He's gonna panic. What happens when you panic? It's not even panic sell. Sometimes you don't even panic sell. You're just looking at it. You're like, fuck. And what you do, you start hoping. Like, how many of you have been in a position where you're just like, you risk way too much because you really wanted to make a certain amount that day, and you're like, fuck, this thing just went the opposite way. And the more time you're thinking about the mistake you made, the price is going down. You know what I mean? You're in the trade and you're over here thinking, you're like, oh dude, I'm such an idiot. Why did I get into this trade? You're over here blaming yourself, and then you're not even cutting your trade. You're just thinking at this point. And then now what? And the next thing you know, 10 minutes later, you decide to sell. This $5,000 account is now at 2,000. Now, what happens when you have $2,000 left and you lost all that in one day? Now you have $2,000 left. How many times harder is it gonna take you to gain that, to get back to 5,000? Right? Because now you have to make at least 100% of this 2,000. If you make 100% of this 2,000, you're still at what? 4,000. And what usually happens, even after you make back some money, you're still what? You're not satisfied. Yeah, you're still down, but you're not satisfied with how you ended the day. Does that make sense? Like, you're not satisfied because you're not in profit and you still lost 1,000. Right? That number is going to stay in your head. You're going to be like, dude, I need to make this 5 back. I need to make this 5 back or more. Right? It's better than losing 3K, obviously, but sometimes the way people think, it's like, it doesn't make sense. Okay, so now let's go to more risk management. Good risk management, okay? If you have a $5,000 account, this is how you kind of grow it, right? If you use 10%, how much is that per trade? 500 per trade. What is 5,000 divided by 500? So how many trades can you make in one day with $5,000 account and using 10% each? 10. Let's say you have 10 trades, right? Now that you have 10 trades, let's say 6 of those trades are profit. Okay, now let's say those 6 trades you made 50% profit on those 6 trades. How much do you make in total? How much do you make? Someone says 3,000, someone says 1,500. 250 times 6, $1,500. Okay, now the 4 losing trades. Okay, now let's do this. Let's say you have a, hold on. Okay, yeah, let's say you have a stop loss of 10%. How much, what is the most you're gonna lose out of the 4 trades if you have a stop loss of 10%? 200. What is your profit for the day? $1,300. Okay. Your account is now at 6,300. Now, let's do this again. Okay? You guys got this already? I'm going to show you how long it takes to grow your account, right? Just bear with me because this is going to make sense. This should already make sense. So now you have 6,300 next day, okay? 6,300. Let's say you use the same risk management. 10%. 6,300 times 10%. You're risking about 630. Someone said, isn't $50 too much for a stop loss? Too small. Okay, you can say it's too small, but what if you're trading a breakout? Obviously, you don't know what's going to happen, right? You never know what's going to happen. You can always extend that 50 to 100. You can extend that 50 to 100. I'm not saying like, only use 5 to 10% risk stop loss. You can do 20, 30%. Even if you make 20, 30% stop loss on those trades, are you still going to profit for the day from those 50% profits? You're still making money, right? It's just now you made money because you're able to kind of divide your account evenly and use risk management on every single one of those trades, right? Now, instead of using 630, let's say you just use an average of 600. How many trades can you make with 600? 10, right? Let's say you make 10 trades still. Let's say 6 trades this day. Let's say let's say on this day, just because you made $1,300 the other day, let's say you want to use 20% of your account on every single trade. Let's say you use $1,200 per trade. How many trades is that? 5. Okay, times 5 trades. Now let's say 2 of these trades are 100% profit and 3 trades are at 20% stop loss hit. What is the total profit? Now your account is at what? Around $8,000. And you know what you didn't have to do to make that to get it from 5 to 8 in 2 days? You know what you didn't have to do? What did you not have to do to get it to 8? You didn't have to go all in and try to flip your fucking money right away. You didn't have to get into a 80% position. All you had to do was find 2, 3 opportunities, let these opportunities come to you, and take advantage of it. Does that make sense? Were there at least 3 opportunities today that you could have traded and made this money? Yep. Was there at least 3 trades yesterday? Yep. Were there at least 3 trades on Friday? Yeah. Right? It's all in your head. Like if you can't risk money, then you shouldn't be trading. At the end of the day, you have to risk money. Once you get over the fact that you have to risk money and you completely eliminate all the anxiety that comes with risk, you'll be fine. Right? What you have to do now is just find a strategy that works for you. And then you test it out. You go ahead and test it out. Take like maybe a week, right, to just back test your strategies. Go on TD Ameritrade. They have this thing called on demand, right, where you can test all your strategies. You can literally go back 5, 6, 7 years. I think you can go back that many years and just test out the strategies. Because this is what I used to do. I used to go back like a year. Back when I first started, right, I couldn't find a strategy that worked for me, right? I didn't trade price action until like last February. Not this February, last February, right? I didn't start trading price action until then. So what I was doing was I was essentially, looking at all these different indicators and doing all this stuff, right? But what I would still do was I would combine, okay? I would combine these indicators together. What I would do is I would go look at YouTube videos, like all these YouTube videos, I'll go through all of them just to see if I'm watching a video on EMA, on RSI, I want to make sure I get it from like at least 5 different traders. I don't want to just sit there and listen to one person tell me what an EMA is. I have to compare his opinion to 5 different people, to the other 4 people, to see if what they say is the fucking same. Because if 3 people say this and 3 people say the other 2 say a completely different thing, I'm just gonna get confused. I'm gonna be like, what the fuck? Like, you know what I mean? Like, who really knows what they're doing here, right? So I've run into those situations where I'm looking at these different indicators and strategies, and like all like they're literally contradicting each other. So what I decided to do, right? I used the ones that I found people would agree with. I would take that, implement it for me, and then I would look at the ones that people disagreed on, and I would do further research on that. Okay? I would kind of figure out for myself by back testing it, seeing it for myself instead of listening to somebody talk about it. I would go on demand and trade. Let's say I can do last week. Let's say I can go back to last week on Monday, pretend I'm trading the open, right? And trade that using the indicators I just learned. And I'll see how it works out for the first 20 minutes. And then what I will do is I'll go back another week and I'll do the same thing for like fucking 5 hours a day. That's what I used to do. Like 5 hours a day, I used to do that all day. I used to just sit here from like 8 o'clock or 9 o'clock at night until like 2 o'clock, and I'll do back test. After I do back test, I'll make the watch list for the group. Okay. I mean, that's how I got to this point where I kind of know what I'm doing now, because I've fucking done like a lot of different strategies that I found like doesn't work as good as what I'm doing now. You know what I mean? Just because what we're doing now kind of seems a little simple. Like you guys are gonna see when we talk about technical analysis. But what I'm gonna do is I'm also gonna go over all these different indicators that are out there and see how you can input them on your chart and see how, because the thing is, right, price action, like for example, okay, there's like 100 of you here. Price action may not work for 40 of you. Maybe 10 of you can what is it called? Can benefit from using RSIs. I'm just using that as an example. Maybe 10 of you are gonna benefit from using MACDs, right? Because how many how many of you think that, I mean, how many of you have seen that certain strategies that work for different people don't work for you? No matter how hard you try, this doesn't work for you, right? Sometimes that's true, right? Because the way people think, right, it's different. You know, you're not gonna think the same as the next person. You're not gonna be as patient as the next person. You don't have as much, maybe you don't have as much money as the next person, whereas the next person is comfortable holding his positions. And then he ends up in profit and you don't end up in profit because you were too scared to hold that position because you were not confident. And confidence can tie into a lot of different things. Like you can end up not being confident because the way you view the money in your account, you hold that money in terms of its value, you hold it at a higher standard. So now you're like, oh fuck, I can't lose this 5,000. I need it. How am I going to pay for rent? Now, if you compare that to someone else who's using 5,000, but he has $1 million in his bank account, the guy with $1 million in his bank account is not going to care about that 5,000. So if he ends up holding it longer than you are and he ends up in profit, that's because he was willing to take that risk. Does that make sense to some people? Hope that makes sense. Because that's like the most important, like one of the most important psychological aspects of trading that I learned. I learned this from like his name is Rand Howell. You guys know this? You guys, anyone know who he is? He's a psychologist. He's a really good trader. But he just stresses the importance of psychology, and that's we're gonna go over that I think next week. Rand Howell, RANDE space HOWELL. Okay, he's a very very good teacher too. But yeah, I'm gonna end this here. Appreciate you guys for sitting through it. Gonna go over a lot more things on. This is just like an introduction to this is just talking about fundamentals, which is not really too big. Yeah. Appreciate you guys for coming. And before you guys go, what is it called? Yeah, you guys are gonna get the emails. So when you have like for example, in like a few weeks, when we have it all up on the website, it's probably going to be different than what we have it, how we have it right now. You know how I have all these PowerPoints? It's probably going to be different PowerPoints. Yeah, I can share this PowerPoint with you guys. I can definitely share it. I can just link it to you guys so you guys can see it. And this is recorded too, so I'm going to put it up. I'm going to put it up on YouTube. I hope you guys enjoyed class today. We went over a lot of basic stuff that you guys, it's very important to learn these things, is what I'm saying, right? Even though it's kind of boring, it's still knowledge, you know what I mean? Like you still have to kind of understand how, like if you, like how many of you learned new things on sectors today? You know what I mean? How many of you didn't even know what a sector was? You know, how many of you didn't even know what a freaking, what the fucking Dow theory was? You know? But now that you know it, you're like, oh my gosh, it's actually essential. You know what I mean? Everyone fucking goes on YouTube to look at, patterns, strategies, candlesticks, this and that, but they don't even take the time to learn this, right? Which makes sense, So hope you guys enjoyed class today. Yeah, if you have an Instagram and you took a picture of the class, just tag me, blah blah blah. I'm gonna upload this today on YouTube and just link it if you guys want to rewatch it. Yeah, we're gonna talk about a lot more risk management in the future. That was just kind of like a brief introduction. I was just using a $5,000 account as an example. So appreciate you guys for staying in.